Hey everyone, it's Sumit Roy with ETF.com, and I'm here at the sidelines of the Inside ETFs conference in Hollywood, Florida. I'm joined with Adam Perlaky, who's from the World Gold Council. Adam, it's a real pleasure to see you again. I know we talked yesterday in our commodities panel, and you said something that really stuck with me, and that is that gold is not like other commodities. So I really wanted to pick your mind about that. Why don't you tell me more?
Sure, absolutely. So we think of gold as its own asset that can stand on its own merit. There's obviously some supply and demand components to it like other commodities, but what people don't realize is that gold has actually performed over time on pace with the S&P 500 over the past 10, 20, and 30 years. It also has what we like to call a dual nature. So you have the performance in up markets, but when you have pullbacks in the market, risk-off scenarios, that dual nature kicks in to where it provides a risk diversifier or a hedge.
And that's distinct from other commodities which don't necessarily provide that, like oil, like even silver, for example, right?
Right, yeah. So again, the correlation of gold to commodities tends to be more positive when you have bull or up markets, but the correlation breaks down and actually becomes increasingly negative when you have down markets.
Interesting. And I was reading the World Gold Council's Gold Demand Trends report that came out recently, and something that was incredible to me was that central bank gold buying last year hit a 50-year high. I think it was the highest or the second highest level ever. Tell me about that, and tell me, is it going to continue, and what other supply and demand fundamentals are you looking at?
So yeah, we were pleasantly surprised last year with the amount of central bank buying. They bought 650 tons, which, as you said, was the most that's been bought since prior to the gold standard. And we think there's a couple reasons for this. So there's a lot of uncertainty in the markets right now, and we're seeing a lot of countries basically diversifying their exposure. In particular, there's countries in Asia and some countries that have trade exposure to Asia, like Russia, that are moving towards a de-dollarization policy, again, to get that diversification and country exposure.
And that's something you expect to continue?
Yeah, absolutely.
Okay. And before I let you go, Adam, I really want to get your opinion on this whole Bitcoin versus gold debate. It was a big debate last year. Bitcoin's come down, so there's less of a debate now, but where do you stand?
Yeah, absolutely. So we get asked this quite a bit. About a year ago, we wrote a paper, which you can check out at goldhub.com. It's a new data site we put out within the World Gold Council. And basically, we looked at whether or not Bitcoin could replace gold, and we found that it's absolutely not the case. We recently revisited that because if you realize in the fourth quarter last year, it was one of the first times that Bitcoin and cryptocurrency had an opportunity to exemplify its status as a hedge or store of value. And simply put, Bitcoin failed. You saw Bitcoin down more than 50% in the fourth quarter. It was heavily correlated with tech stocks, while at the same time, you had gold up 9%. So while we see some value and merit to financial technology, blockchain, that sort of thing, Bitcoin and other cryptocurrency tokens just simply have not proven that they can replace gold.
Great point, Adam. It seems like gold has proven itself over decades, over millennia, while Bitcoin has a lot to prove still.
Absolutely.
That's a lot of great information. Thanks so much for joining us, Adam.
Thanks for having me.
And thanks for tuning in on the sidelines of the Inside ETFs conference in Hollywood, Florida.